In 3 trading sessions, SpaceX investors watched roughly $600 billion disappear. Not over a year, not over a quarter, 3 days. This is the company that just pulled off the largest IPO in stock market history and then proceeded to erase more wealth faster than almost any newly public company ever has.
A little company that started in a warehouse in El Segundo is now going public with the largest IPO ever.
For over 20 years, SpaceX has defied people's belief of what's possible.
We have a history of making history.
Do things that people said you couldn't do.
The impossible is only impossible until it's possible.
And then just outwork everybody else around you.
Don't just work hard, work on the things that matter.
Today, we're breaking down exactly what happened, who called it before it happened, and the facts about this deal that almost nobody is talking about. If you've been anywhere near financial media this month, you've heard about SpaceX, ticker SPCX. It went public, it went vertical, and then it cratered. And along the way, it made Elon Musk briefly the most talked about trillionaire on Earth. But underneath the headlines, there's a much stranger story involving a surprise bond sale, a tiny sliver of tradable stock, billion-dollar AI acquisitions, and some of the most respected and most feared investors in the world all weighing in. Let's get into it. Start at the beginning. On June 12th, SpaceX priced its IPO at $135 a share, selling over 555 million shares to raise $75 billion. That's not just big. That's the largest initial public offering ever recorded. Bigger than Saudi Aramco, bigger than anything Wall Street had seen before. 3 days later, underwriters exercised the green shoe over-allotment option, basically extra shares set aside for high demand, pushing total proceeds to $85.7 billion. Then, things got wild. By June 16, shares had surged 67% from the offer price, hitting an intraday peak of $225.64. At that moment, SpaceX's market cap touched roughly $2.6 trillion, briefly making it one of the 5 most valuable public companies on the planet, vaulting past Amazon and Microsoft. Options trading on day 1 alone saw over 1 million contracts change hands, an almost unheard of level of activity for a brand new listing. Then the chart did the exact opposite. Over 3 straight sessions, the stock cratered, closing at $154.60 on June 22nd. That single day alone saw a 16.4% collapse. Measure it from the closing peak, and roughly $600 billion in market value vanished. Measure it from the intraday high 3 days earlier, and the number balloons to nearly $920 billion gone. So what actually triggered the June 22nd crash? It wasn't a bad earnings report. SpaceX hadn't even reported earnings yet as a public company. It was an SEC filing. That morning, SpaceX confirmed it was launching its first ever investment-grade bond sale, targeting at least $20 billion in senior unsecured notes. Bloomberg had actually reported this was coming days earlier, on June 18, but seeing it confirmed in black and white rattled investors, for one simple reason. This happened just 10 days after the company raised the largest amount of equity capital in history. If you just raised $85.7 billion, why do you suddenly need $20 billion more in debt?
The bond documents gave part of the answer. SpaceX disclosed roughly $100.8 billion in cash on hand, but also $29.1 billion in long-term debt, much of it bridge financing tied to the company's February acquisition of Elon Musk's AI startup XAI. All 3 major credit agencies still rated the bonds investment grade, Moody's at Baa1, Fitch at BBB+, S&P at BBB. But the optics of needing fresh debt this fast spooked a market that was already trading on pure momentum. Here's the part most coverage skips. A long list of credible market insiders were waving red flags before the crash, not after. Veteran hedge fund manager Doug Cass of Seabreeze Partners publicly said he'd pass on the IPO entirely and was planning to short the stock, valuing it closer to $70 a share, about half the offer price. He didn't hold back on the financial media coverage either, accusing TV commentators of throwing out confident price targets without doing real valuation homework. Then there's Michael Burry, yes, the big short guy. Burry looked seriously at buying put options to bet against SpaceX and ultimately walked away, saying the options were simply priced too expensively given the risk. His exact words, he was neither short nor, long. But he did note something striking.
that SpaceX's valuation had, in just days, eclipsed Berkshire Hathaway's by 2.5 times over, a company built over decades by two of the greatest investors in history. NYU valuation professor Aswath Damodaran ran his own numbers and landed on a fair equity value of about $1.3 trillion, roughly 26% below the IPO's target. He went further, calling the $28.5 trillion total addressable market figure in SpaceX's prospectus a hallucination. Gary Black of the Future Fund flagged something more technical, but just as important. He said the early trading action looked more like a meme stock than a fundamentals-driven company, pointing out there had been almost no way to short the stock or buy puts in the first few days, which artificially inflated the rally. He also noted SpaceX was trading at roughly 175 times its estimated 2026 EBH, leaving no room for error. And venture capitalist Steve Westley, a former Tesla board member, summed up the bull case's fragility best. He described SpaceX as essentially 3 separate moonshot bets bundled into one stock, and said at least 2 of those 3 need to actually pay off to justify a $2 trillion price tag. Now here's where it gets really interesting. The structural details that explain why this stock moved like a rocket in both directions. Fact 1. Only about 4 to 5% of SpaceX's total shares are actually available to trade publicly. The other 95% plus is locked up. That tiny float means even modest buy or sell orders can swing the price by huge percentages in minutes. And it's exactly why the stock could rocket 67% one week and crater the next. Fact 2. Elon Musk's roughly 42% ownership stake is locked until June 2027. Moody's specifically flagged this as a governance risk in its credit rating. That much voting power concentrated in one individual. Fact 3. Right in the middle of all this, SpaceX announced a $60 billion all-stock acquisition of Anysphere, the company behind the AI coding tool Cursor. That deal alone diluted existing shareholders by roughly 3.4%. And it's part of why Morningstar cut its fair value estimate down to just $62 a share, making SPCX the second most expensive stock in that firm's entire coverage universe. Fact 4, and this one rarely gets mentioned. Despite the $1 trillion valuation, Starlink is currently the only consistently profitable part of SpaceX's business, generating about $4.4 billion in EBIT in 2025. Meanwhile, the new AI division actually lost $6.4 billion that same year. SpaceX has accumulated $41.3 billion in total losses since it was founded back in 2002. Fact 5. The spending is about to get a lot bigger. Evercore ISI projects SpaceX's annual capital expenditures could rocket from around $20 billion in 2025 to a staggering $732 billion by 2031, with roughly $666 billion of that aimed squarely at AI infrastructure. And fact 6, this isn't pure speculation. SpaceX already has real contracted revenue on the books, including a reported $30 billion cloud computing agreement with Google running through 2029, and an agreement with Anthropic worth roughly $45 billion over about 3 years. It's not all bearish, though. Cathie Wood's ARK Invest used the June 22 crash as a buying opportunity, scooping up roughly 210,000 shares across its ETFs, a purchase worth about $32.5 million. On Wall Street, Oppenheimer analyst Timothy Horan actually raised his price target to $250 after the Cursor acquisition, arguing the deal benefits both companies by giving Cursor access to SpaceX's computing infrastructure. And there's a structural tailwind coming too. TD Securities analyst Peter Haynes flagged July 6th as the likely date SpaceX gets added to the NASDAQ 100 index. BNP Paribas estimates that inclusion alone could force roughly $8 billion in mechanical buying from index funds that have to hold the stock regardless of opinion. So what happens from here? 2 forces are about to collide. On one side, that NASDAQ 100 inclusion is pushing billions of dollars of forced buying into the stock. On the other side, insider lockup expirations are approaching, meaning early shareholders who've waited years for liquidity may finally start selling into that demand. Then there's the first earnings report as a public company, expected in late July or early August, the first real chance for revenue numbers to either support or undercut the valuation investors paid for. And looming over everything, both S&P and Goldman Sachs, SpaceX's own lead underwriter, are projecting negative free cash flow for years to come. with Goldman forecasting negative $105 billion in free cash flow in 2029 alone, before the company is expected to turn cash flow positive in 2031. The question every SPCX holder is really asking right now isn't complicated. Was the $600 billion crash a healthy gut check after an irrational mania, or the first crack in a much bigger story? This is one of the most fascinating market stories of the year, and it's far from over. If you found this breakdown useful, hit subscribe. We'll be tracking SPCX through the lockup expirations and that first earnings report. Drop a comment. Do you think SpaceX stabilizes here, or is there more downside coming? And as always, this video is for informational purposes only, not financial advice. Do your own research before making any investment decisions. See you in the next one.